Imagine waking up to see a company Wall Street once celebrated as the next revolutionary food giant, a stock investors pushed beyond $200 per share, now circling $1 as if suspended between survival and disappearance. A company that once promised a global food transformation now signaling distress through a debt exchange so unusually large that it could multiply its share count several times over. A company that spent years telling investors its long-lived assets were fully valued, only to suddenly declare those same assets needed material impairment. And a company whose stock, in one of the strangest market episodes in recent memory, exploded more than 1,000% in a matter of days before falling right back. For seasoned investors, these events are not just concerning. They are deeply abnormal in a structural way, the kind of abnormalities that usually indicate unspoken stress points or inconsistencies in disclosure that have not yet been fully explained. To understand how this mystery formed, we need to return to the beginning. Beyond Meat, a US-based NASDAQ company, entered the public markets during a cultural moment. Normally, when consumer goods brands go public, they grow in a predictable sequence, with distribution expansion, gradual margin improvement, and brand consolidation. Beyond Meat bypassed this order entirely. Its ascent was driven less by fundamentals and more by narrative momentum. The global excitement around plant-based protein, the environmental storyline, and partnerships with major restaurant chains pushed the stock far beyond what traditional metrics could justify. But financial gravity always returns. Between 2022 and 2023, U.S. retail volumes did not decline slowly, which is the usual pattern in consumer category fatigue. They dropped abruptly. Total company volume fell from around 80 million pounds to roughly 70 million. A drop this steep, especially while distribution was still expanding, is unusual and hints at deeper structural issues like weaker repeat purchase rates, a widening taste gap against traditional meat, and inflation-driven price sensitivity. While this contraction was unfolding, the company began a global operational review. Usually, such reviews update the valuation of long-lived assets, like manufacturing equipment or production facilities, and impairments are recorded when future cash flow expectations decline. Beyond Meat instead reclassified certain assets as held for sale, but recorded no impairment. That was the first major anomaly. When a company faces declining demand and weaker margins, impairments are normal. The absence of impairments under such conditions suggests assumptions that were unusually optimistic or valuation models that did not reflect operational decline. By 2024, revenue settled near $330 million, confirming continued deterioration. Normally, a struggling brand would pursue large strategic pivots or product reformulation. Beyond Meat instead pursued defensive restructuring, stepping out of China, reducing headcount by about 6%, cutting marketing, and bringing in an interim transformation leader. Yet revenue in Q2 2025 fell to around $75 million, nearly 20% lower than the previous year, and Q3 revenue hovered around $70 million, with gross margins collapsing toward 10%. At that point, the company was not stabilizing. It was contracting in a way consistent with distressed consumer businesses. Then the capital structure stress emerged. Beyond Meat carried about $1.15 billion in 0% convertible notes due in 2027. Under normal financing behavior, convertibles convert into equity when share prices rise meaningfully. In distress, they become liabilities. Most companies in this situation negotiate modest exchanges or refinance through lenders. Beyond Meat did something far more extreme. On September 29, 2025, it proposed exchanging the entire balance for new 7% payment-in-kind notes due in 2030 and potentially more than 320 million new shares. Dilution of that magnitude is not typical. It resembles a full recapitalization and implies that traditional refinancing was unavailable or internal liquidity projections were deteriorating. The market reacted instantly, sending the stock down more than 30% and to new lows. But the real break in narrative came shortly after. On October 24, 2025, Beyond Meat announced it would record a material impairment for the quarter ending September 27. The timing was startling. For years, the company had stated no impairment was necessary. In normal accounting behavior, impairments arise gradually alongside performance decline. Sudden, large impairments are atypical and often imply earlier valuations were optimistic or that internal conditions deteriorated faster than disclosures. Multiple law firms, including Blakemar, Fonte and Ald, announced investigations into possible securities law violations, asking whether past reporting overstated asset values. When impairments appear abruptly after years of pressure, this suggests earlier risk signals may have been understated. Such a shift matters because asset valuation accuracy directly affects solvency analysis and investor trust. And while these internal tensions were mounting, the market experienced a bizarre and violent rally. In mid-October 2025, days before the impairment announcement, Beyond Meat's stock surged more than 1,000%. A trader publicly claimed to have taken a large position. Under normal market conditions, a distressed equity does not rally tenfold. But Beyond Meat had another anomaly. Nearly 49% of its float, roughly 35 million shares, was sold short. In typical markets, short interest above 20% is unstable. At nearly 50%, a stock becomes a pressure cooker where minor buying triggers massive short covering. Short sellers went from about $80 million in cumulative profit to roughly $45 million in losses within days, and then the stock collapsed back to about $1. These events form a cluster, not isolated incidents, and clusters of anomalies often imply undisclosed stress points or inconsistent internal metrics. Beyond Meat now shows a distressed company proposing an unusually large recapitalization, a sudden impairment after years of saying none were required, multiple legal investigations arriving immediately afterward, a meme-driven super spike in a declining business, a short interest level approaching half the float, a stock that refuses to drift towards zero even while revenue falls, margins collapse, impairments rise, and Altman Z-scores sit near -3. For investors, these inconsistencies force core questions. Why did impairments lag performance decline by years? Why was the debt exchange so disproportionately large? Why does the stock still retain value despite clear distress signals? Why did short interest remain elevated without earlier unwinding? And is the market pricing future optionality or reacting mechanically to speculative pressure? Several theories exist. One suggests speculative capital assigns optionality value simply because the stock is cheap. Another suggests short interest itself prevents collapse. A more skeptical one argues that earlier asset valuations may have masked deterioration, and the impairment is only the start of deeper adjustments. Yet another wonders whether speculative behavior, not fundamentals, is artificially supporting price. Whatever the explanation, the implications are significant. Impairments may increase legal exposure. The debt exchange could drastically dilute shareholders. A prolonged price below $1 could trigger delisting pressure and potential reverse split. And category demand may continue to contract, making restructuring insufficient. These realities shape trading strategy. In the short term, $1 functions as a psychological pivot. Below roughly $0.8 lies the historical trough. Between $1 and $2 sits resistance shaped by short-term moving averages. Volatility here can be traded, but only with strict discipline. In the medium term, Beyond Meat resembles a distressed equity option with entry near $1 and exit targets between $2 and $3 based on temporary re-rating or meme activity. In the long term, the thesis becomes binary. Sustained value requires stabilization, margin recovery, governance credibility, litigation resolution, and structural improvement. Such recoveries are statistically uncommon, so long-term positions must accept the risk of total loss. Beyond Meat's narrative is not simply a story of declining revenue. It is a story of contradictions between disclosures, performance, and price behavior. Mysteries in markets emerge when these contradictions align. Beyond Meat now sits at the center of such misalignment, a company fighting to reconcile its financials, its narrative, and its market identity. And before we close, ValueStir wants to hear directly from you. If you have a publicly traded stock, a private company preparing for listing, or any coin or token you want us to investigate on this channel, leave a comment and tell us. We take viewer submissions seriously, and your ideas help shape what we cover next. To everyone who watches, subscribes, likes, comments, and shares these episodes, thank you. We see your support, and we will repay it with even stronger, deeper content ahead. This was ValueStir.